Now, this fund has a value bias and it focuses on high quality funds and investment trusts that are in out of favor areas. So, how does this philosophy kind of shape the portfolio construction in today's markets?
Well, I think the first thing to say is that it has been a very difficult market environment, and it has been so for months now. A lot of our managers are telling us that it is actually the most difficult market that they've had in their career, and some of them go back quite a few decades. And it's not just because the reason why it's been so difficult is that it's not driven really by fundamentals. It's not necessarily driven by sentiment either. It's not a question of value versus growth. It's just very, very difficult when you look at day-to-day moves in share prices to pinpoint exactly what is driving those moves. So that is why it's very difficult. For us in the multi-manager growth fund, so we're a multi-manager fund, the way I look at it is that we've got three levers really at our disposal. The first one is asset allocation, which in this environment is very difficult. The second one, luckily, that we have at our disposal is fund selection. So that's where we go and try and find the best fund managers out there. And the last one is timing. So what do we do with those funds once we found managers that we particularly like is the times at which we take profits, the times at which we add to our positions, etc. And I think having at our disposal fund selection is extremely important in a market like today, which is, as I said, very difficult from an asset allocation point of view. We can rely on some of the best fund managers out there to provide us not only with returns, but also more importantly, with some margin of safety. So if we look over the recent months, of course, we've been underperforming the tech-driven markets, but that's what you would expect from us. As you said, we are value biased, so you would expect that from us. We've been keeping up with the broader equity market, however, so that is quite satisfactory. It is getting harder to find absolute value out there, but there is still a lot of relative value available across asset classes, and that's why we're still very optimistic and excited about the prospects for future returns in the fund. And another point that I would make is value doesn't mean it doesn't mean boring, investing in the boring things. Everyone at the moment is getting excited, some might say overexcited by AI and technology, etc. And just because we've got a value bias doesn't mean that we avoid those sectors completely. What it means is that we certainly don't want to overpay for assets, but the way we invest is mainly through investment trusts, and by having that tool in our toolbox, we can find many different ways to invest in those hot themes like AI and technology. So it is very important to stay diversified and look for value where you can find it. Make sure you don't get sucked into some of those themes and overpay, and look for those managers that can generate their own value, that can control their own destiny. And the last point that I would make in terms of the overall value that we see in our portfolio, if you look at the average discount of the investment trusts that we invest in the fund, at its tightest, so at the most expensive, was just after the COVID rebound, where the average discount in the portfolio was about 5%. Then we had a difficult period for the investment trust sector that I won't go into it now, but the whole sector saw discounts widening quite a lot. And for the multi-asset growth fund, that translated into an 18% average discount. So we went from 5% to 18, and we're now at 12. So we're off the lows. As I said, value might be a tiny bit harder to find now, but we still think that there is a lot of value around for the upcoming months.
And if you'd like to learn more about the Wise Multi-Asset Growth Fund, please visit fundcaliber.com.